Well, again, welcome everyone. Happy holidays. We're so thrilled you're here. Thank you for joining us for this very special event. We got on Dr. Gaines' schedule early, so we'd have a educated forecast of what 2021 is going to look like post presidential election, all elections for that matter. We've had quite the season, haven't we? So thank you very much for helping me welcome Dr. Jim Gaines at this time from Texas A&M Research Center.
Well, morning, everybody. Well, like we said, this is always interesting. I'm going to try and bring up. Can everybody see that? Are you getting it? Okay, good.
Yes, sir.
All right. Let's see. Well, I can't get that to go off. All right, doesn't matter. Good morning, everybody. I hope everybody's having a good time with all of the goings on. Everybody's got. It was interesting. You get these meetings. At least everybody doesn't have to wear a mask. So you know, and if you hadn't thought about it, it's a really weird time because it's the first time in your life probably that you can walk into a bank wearing a mask and you don't get shot. So it's kind of interesting, and I did it the other day. I did it just for the sake of doing it, so I could say I walked into a bank with a mask on. I didn't really have any business to do. I just decided to do it. Anyway, we're looking at that. The economy is trying its best to get back in gear. The good news, I'm telling you the bottom line before I ever even hit the first click on the slides. The housing market is still doing great. It is the jewel in the crown, if you will, of what's going on around the world and so on. Here's what it looks like in terms of GDP growth. We're officially in a recession if you weren't aware of it. The NBER, which is the official body, the National Bureau of Economic Research that sets the standard and declares when cycles start and stop and so forth. They officially declared the growth cycle that we've experienced since the Great Recession. This started in 2010, ended in February of this year, February 2020. Well, that's no secret because it was in March that, of course, we had all the shutdowns, and that's when we really got serious about the coronavirus and so on. So that ended the growth period. So we started the downturn, which officially becomes a recession. And you can see there on the graph, the first quarter was down 5%. The second quarter was down 31%, which was the worst on record. That's we've been keeping the records on this on the score box on the GDP for some years. And that was the worst that's ever been recorded. And then the third quarter turns out to be the best quarter that's ever been recorded. So we went down 30%, went up 30%. Well, if you know the law of arithmetic, if you go down 30% and then you start measuring from that lower base, you actually have to increase about 50, 60% to get back to break even. So despite the fact that it looks like those two bars offset each other, they really don't. And then the fourth quarter, and the fourth quarter this year and first quarter next year are going to be kind of critical in terms of the transition from the real decline and the problem in the economy and then rebounding. And I was telling Nancy earlier before we started the program, I've actually seen estimates that range from -2% to +20%, but the majority of the economists in the world are in the country here are predicting that fourth quarter is going to be somewhere between 2 and 12%. And if that isn't enough of a wide enough range to tell you, and I'm going to tell you, this is the part of it. There really isn't an economist in the country or in the world right now that knows exactly what's going on or how to predict what's going to happen in the near term future. All of our econometric models, and we have them at the center, and a lot of people have them all over the state. The Dallas Fed up there in your backyard has models. In fact, I was on a call with 3 of their economists here a couple of weeks ago. All of us agreed that, look, hey, we've been looking at this stuff and modeling it and structuring it and trying to, make our projections, but all of our historical stuff is out the window because we never experienced anything like this where we had a mandatory shutdown and the economy, everybody was just told to go home, stay at home, shut down for 2 or 3 months, and then this gradual recovery or gradual reopening of what's going on. Retail spending, people buying stuff in general, goods and goods, especially online, has actually come back and is back up to pre-recession levels or pre-pandemic levels. But the purchase of services and other kinds of activities, so total is not back up. It's still down anywhere from 5 to 9%. So what it is PCE, the personal consumption expenditure, which is about 70%, 66 to 70% of this GDP number, is still down. It's still down about 6 or 7%. And that's the reason why the growth is being so slow coming back into play. Now, you should have bought Amazon stock a year ago. If you didn't, you're out of luck now. But anyway, and incidentally, I just checked the stock market this morning, just before I got online. We're back over 30,000 on the Dow Jones. It was up like 150 points this morning. The 10-year Treasury is right just shy of 1%. It was like 0.9 something. And the price of oil was about 45. Anyway, here's what it looks like in terms of employment. This is the key for our recovery. One of the real key is get all of these people who lost their jobs, and we lost about 20 million jobs back in March and April, and we're still though down about 10 million jobs. We're going to have to see how that's going to work and play out. And it's just going to be a little bit of time. You can see that what happened was over here on the right-hand side, we had the beginnings of what's called a V-shaped recovery. It got about halfway up, and now it's kind of petering out. It's just it's going off to the northeast there. If you look at it like a compass, and you can see that rate of increase on the non-farm employment. If it's going to take a while to get back up to that 152 million jobs that we had in February, just before. And this is, incidentally, this is a great graph of an economy that's fallen off of a cliff. We've never experienced any kind of this kind of drop and decline from 152 million people working to 130 million. That's over 20 million people fewer working within the matter of about 35 to 45 days. We experienced a similar thing back in the Great Depression of the 1930s, but it took about a year and a half to get that kind of a dip. To hit that kind of dip at just overnight in relative terms, it was just astounding. And you can see we're still struggling to get back. Claims, it looks like, it's leveled off a little bit. These are the jobless claims and so forth. And I just updated this slide just before we went on the air. Actually, that 68 million up there is now 69 million. It's because I just got the November 28th week data just this morning. So it's just not there. You can see the little black stubby bars over to the left. That's what the pre-pandemic level of unemployment claims look like. It was in the neighborhood of 200 to 225, 230,000 people per week. And that's not a significant number when you think it's, total people working was 152 million. But we're still running about 750,000 jobs, people per week filing for unemployment. So it's literally three times bigger than normal going. Unemployment rate has fallen down to just a little less than 7%. The unemployment rate right now is a little bit dubious in terms of watching it on a consistent basis, because what's also happening is not only people being employed or unemployed, it's also the labor force, which is the denominator of that ratio. And whether or not a lot of the people who've lost their jobs are going to stay permanently unemployed, or if they're coming back and start now looking for jobs, which is the official definition of being in the labor force. You have to be not working and looking for work to be counted as being in the labor force. If you're not working and you're just sitting at home drinking beer and having fun, but not looking for a job, then you're not officially classified as being in the labor market. So it doesn't count on that unemployment rate percentage. Here's, this is, I'm going to tell you the intuitively obvious things you probably, all of this stuff you already know, but you have to think about it. The very first thing of what it's going to take to get us back into some semblance of normalcy of what we had before all this started is that we got to get the virus under control. Now, the good news is, and we were talking about this a little earlier, Nancy and some of us before we got on the air here, that one of the very, the most uncertain thing right now that's affecting all of our economic projections and everything else we're looking at is the vaccine. And if it's going to be effective and when it's going to be available and how it's going to get distributed and how fast it's going to get distributed and over what, I mean, if we got to vaccinate 330 million people in the United States, and already we know that something like 40% are saying they're not going to take the vaccine or don't want to take it. I mean, it's, which is nuts. But anyway, when it gets out and so on and get the virus under control, we probably will never eradicate the virus. That's what the health experts are all saying. We'll never completely eradicate it, but we can get it under control, get the number of cases under control, minimize hospitalizations, and most importantly, minimize the death rate so that it's not as lethal of a disease as it has been. That's number one. Then reemploy people. I just showed you the unemployment. Increase overall demand. Get people out buying things, buying goods and services, and business spending. Business spending has also been one of those catastrophes that has been way down and affected the overall growth in the economy. Global trade, it hasn't been much of a help so far, but I can tell you right now, it is really, really picking up. Read a report here just within the last week or two that virtually every ocean-going tanker and goods hauling ship are being utilized right now. And there's stuff going back and forth all over the world. So we're looking to see that. Our balance of trade for the U.S. is still on the negative side. We're still importing far more than what we export. And that's all. Inflation has not really been much of an issue and is not anticipated to be an issue here for at least the next year and a half. 2022 is going to be really interesting. 2021 is going to pretty much take care of itself. The 2022, 2023, and the rest of the decade of the 2020s, there's going to be a lot of other things that we'll be winding up talking about 3-4 years from now that we're not talking about today. And inflation is going to be one of them. The good news for all of you in the real estate business, interest rates are going to stay low for a while. I'm going to talk about interest rates. The bad news is eventually taxes are going to go up. And there isn't any way to get around it. Taxes are going to go up. The politicians are scared to death of it. But the spending that's going on from the federal to the state to the local level, the cost of delivering goods, public goods and services is going up. The increase in demand is going up, and so those costs are going up with it, and those taxes are going to go up. The darkest cloud on the horizon on our economy is the level of debt, and it's not only sovereign debt, it's not only our national debt, which temporarily has been skyrocketed. We've had to borrow almost $3.5 trillion, that's trillion with a T, dollars this year, just this year alone, and add it to the national debt. And next year will probably be a lot more because everything, all of the bailout and stimulus payments and so forth. And incidentally, none of this was the CARES Act and all that. None of that was stimulus payment. It was survival payments. They mislabeled it. It sounds better to be stimulus, but it's really survival. But the debt and the corporate debt has been, households have done pretty good. We've been good as individuals and people and keeping our debt levels, even buying more expensive houses. We've managed to keep household debt under control. The one at the household level sector that's a concern is student debt being carried by the millennials. And that is a debt that's going to come back to haunt us a little bit, because nobody's real sure how to take care of it. I know there's been all kind of rumors and talk about with the Democratic administration coming in and whether they would forgive all the student debt. That all you're doing is shifting the debt from one group to another group. It becomes part of the national debt if you wind up doing that. So it's going to be interesting. Here's the bad news. Here's the really bad news. Here's the trend in daily COVID cases. I said the very first thing we got to do is get the virus under control. Well, it doesn't look like to me we're getting it under control. Both the number of cases and the deaths, as everybody's well aware, if you've just been paying any attention at all, that the rate of increase in the cases has been going up significantly. I mean, if you can just see the slope of that line, the blue line there, and even the orange line, which obviously is going to go up as the number of cases increase, the number of deaths are going to increase, even at the same death rate. But there is, the good hope is that right there at the tail end of the line, it looks like maybe it's dipping down and maybe going to head back in the other direction. Although it's still too early to see whether or not the Thanksgiving holiday is going to result in new cases. And now with the Christmas holidays coming up and more interaction of people and so forth and more socialization, because that all the experts are telling us that that's what is creating and creates the increase in the number of cases. Now, let me get to Texas. Texas, of course, this underwent a double whammy. We had first, starting in December and January of this year, and December of last year, January of this year, we had the oil price decline when Russia and Saudi Arabia decided to have a price war and hold their production up and actually increase their production and lower the price of oil. Their secondary target was, of course, the American fracturing industry, trying to get the price of oil down and get the American fracking industry affected as well. Well, that started earlier in the year. And then, of course, we had the virus hit in March, effectively. And so we got the double whammy, particularly here in Texas. And what it's going to mean is that we're going to have a very uneven recovery around the state and around the country, as we're already seeing and experiencing. Here's Texas, same graph, but for Texas, and you can see that we're taking our double whammy here in terms of the daily COVID cases. We had the big run up in June, July, when the governor opened up the economy sooner than a lot of the other states. And it's not a political comment here. It probably needed to be done from an economic standpoint, but you can see the price we paid was, we had more cases, we had more people interacting, deaths went up, but then we got it somewhat under control from about the middle or end of July through until September and so forth, went back down. Nobody's explained that bump up there in late September, but anyway, and now, like the U.S., we're going through our second wave, if you will, of increased COVID cases. Had a drop off here in November, but then the last week here of November, we've had an uptick again that may be the beginning of that Thanksgiving effect, if you will, on the caseloads. The really good news, as far as I'm concerned, looking at this is the orange line, the dip in the deaths. I mean, really what makes more sense is to pay attention to how many people are dying from this thing. It's not like the Spanish flu of 1918 that killed about 30 million people around the world. But we can see, and one of the things I know that, for example, one of the reasons for the run up in the cases there was schools opening back in September and leading into October. And I know here, at least here in College Station, we had a real rise in the COVID cases, but it was in the 18 to 24-year-old age groups. Well, generally they're healthier and don't die from the COVID. They get sick, but they don't die from it. So the death rate was actually going down. We'll have to see how that runs. All right, everybody, you look at economics in Texas, you got to look at rig count and price of oil. And you can see what the rig count has done. That's the blue line or the dark line here on the graph. And from 2018, when we peaked out at 540 rigs, we're down to 147. And that's actually up when we really bottomed out at right at 100 rigs, active rigs going on back in late August and in September. And you can see what the price of West Texas Intermediate did. Back there in April, that big dip right there, and that's a tremendous dip over a short period of time in just a month or two. And it started, you can see, back in January. That was when the Saudis and the Russians decided to have their price war. But you can see, and actually one day it went negative. The producers, for example, were literally paying people to take the oil off their hands because they didn't have any place to put it. And they didn't know what else to do with it. So one day it actually went negative. I think it was about $35 and some change. But on a monthly basis or a weekly basis, the price went down. I think it was $3.50 or something for that week of April 24th. And then since it's bounced back, and like I said, I looked at it this morning just before we went on the air here, and it was right at about $45, which is about what the graph here, these are weekly prices, is showing over there on the right scale. So it's trying. Now, some of the experts are saying that the price could conceivably come back up into the 50s during the course of 2021. If that happens, the rig count will come up a little bit, but it isn't going to be enough. We're seeing significant secular changes in the energy market, a lot of consolidations, mergers and acquisitions, bankruptcies. A lot of the venture capital that was flowing from the hedge funds from New York and other places is drying up. There's going to be a restructuring of the financial market. There's going to be a restructuring of the operating process and the drilling and the activities. And that's going to include the services sector as well here in the coming year or 18 months. And so that's already started, and it probably will hit with even a little bit more strength here as we go forward a little bit. Weekly unemployment claims in Texas, very similar to the national kind of structure. These generally run about 2 weeks behind in terms of the reporting. We get the federal numbers, the national numbers about 2 weeks before we get the state numbers. But in October, we did add about 118,000 jobs, which was really good. Actually, in the private sector, I think we added something like 135,000 jobs, but the government sector lost jobs in September and October. A lot of the people that were working on the census for the federal government dropped off payrolls of the federal government. So it affected the total that way. But you can still see, compare the red bars out to the right with the black bars over to the left, and it's running very similar to the national number, about 3 times the quote unquote normal rate of unemployment claims on a weekly basis. Statewide, we're doing a little better in terms of recovering our jobs that we lost back in March and April. We had a tremendous drop off in jobs, lost about 1 million jobs. We're still down about a little over 500,000. Actually, we lost, about 1.5 million jobs. And we're still down about 500,000. You can see on the numbers there, it's about 4% down year over year, October this year, October 2020 compared to October of 2019. So this does look more promising. Texas opened up its economy a little faster, sooner than some of the other states. So we added jobs back a little quicker. The leisure hospitality and of course the mining and extraction industries are still way down. Those 2 industry groups are down, but the rest of the industry groups are doing pretty much. We need about another 500,000 jobs to come back to just sort of break even, 550,000 jobs, and at 120,000 jobs a month. It's going to take 4, 5 more, 6 more months before we get there, because that's just sort of an average number. Here's a chart we put together at the center, looking at all of the metropolitan areas in terms of their percent job recovery based on the October jobs to the February level. And you can see that Austin and Dallas rank in there at 4 and 5%. Dallas, Plano, Irving, which is the east side of the Metroplex, is right at about 97%. Fort Worth, Arlington, a little bit down, about 95.5, about 96%. It's not that big of a difference. And of course, Fort Worth has more manufacturing capacity over there, where Dallas, Plano is more services based. And a lot of Dallas, Plano, a lot of the services type jobs were the type jobs people could work more easily remotely. It wasn't as hands-on like manufacturing and so forth. So the decline wasn't nearly as bad. And you can see it's kind of commonsensical. You can see Midland, Odessa down there toward the bottom. In fact, most of them down toward the bottom are either in the valley or they're basically energy related areas, which got hit harder with the double whammy with the energy sector. So for example, you see Houston there at number 17 has not recovered quite as well as Dallas and Austin and Fort Worth and San Antonio, because they got hit, Houston got hit a lot harder with the loss in the energy sector. Okay, here's what unemployment rates look like. I gave you October of a year ago, so you can see just how good things were when, unemployment is less than 4%. And in the case of Austin, even less than 3%. It's almost absurd low numbers. Dallas Fort Worth as a metroplex was at 3.1%. Peaked in terms of the downturn at 12.6 and currently is running at about 6.1. Again, I pointed out sort of you want to take some of these numbers with a little bit of grain of salt, but at least relative perspective gives you an idea of how well we've done. And basically, like I said, from 12.6 unemployment to 6.1 for Dallas Fort Worth, it's about 50% recovery, and it looks that way. I'm giving you the same sort of slides at different geographical levels so that you can see what it looks like. And you can see for Dallas Fort Worth overall what the job situation looks like. It's trying its best to recover. It looks like within the next, somewhere in the next 3 to 6 months, in the next 2 quarters, fourth quarter, first quarter of next year, probably get back up to about that 3.9 million job level that we had in February of this year. It'll take a little while to get there, but it's doing well, down about 3%. It could be a lot worse. So in a sense that's the V-shaped recovery that a lot of times we were hearing about in terms of the economy. I still think that on an annual basis, by the time we end the year and so forth, total employment will probably be about down 1.5%, because it's a mixture, combination of the whole year, where it's been growing about 2.5% a year for the past several years. I think 2021 will look more like a typical year, probably get a 2 to 2.5, maybe even a 3% growth rate, but that's because it's going to get measured against 2020, which is down a little bit. So it'll make the percentage increase look a little better. Dallas is doing fine. People are still moving to Dallas. Companies and businesses are still moving to Dallas and to Texas in general. And of course, Denton and Wise counties are getting their share of it. Here's Denton County annual employment. 2019 was up about 2.5%. It looks like on a year-to-date basis, 2020 is down about 3%, down a little bit more than the whole metroplex, and it looks like it'll end the year like that. And again, I'm saying to you that 2021 will probably come back up pretty close to the 2019 number, maybe even exceed it. So the percent increase is going to look even better because it's going to get measured against the lower number of 2020. Wise County, the same kind of thing. Wise County is total employment right now on a year-to-date basis is running about 4.7% below 2019 level. But again, I think we'll see this recovery pick up here, especially as we get the vaccine out. Now, I don't think that we're going to see real impact of the vaccine coming out. The first impact is going to be psychological. People are just going to think and believe, okay, well, now we got a vaccine, things are going to be great and so on. But it's going to take a while before we see the reality of that, which we probably won't really see it full force until at least the second or third quarter of next year. So sometime in the spring or summer of next year, we'll really start seeing it. And by the end of the year, we'll be doing a lot better and pull all this back up. And so again, in Wise County and in Denton County, in both counties, 2021 employment come back up to about the 2019 level, or maybe even a little bit better than that. And it'll be a significant percentage increase going on. The housing market has been doing great. Interest rates, I told you I'd talk about interest rates. We can't talk about housing without talking about interest rates. The weekly rate for the 30-year fixed mortgage rate, which is the black line, just reported, I think yesterday or for last week, hit 2.71 on a national level. As all of you know, to talk about these rates in generalized terms, and that's the Freddie Mac rate that we're reporting there. It's a little bit different because, it really depends on the person borrowing the money and their credit rating. And if they go for a 15-year mortgage, they can probably get an interest rate less than 2.25 or in that ballpark. I saw lately where it was get 2.15%. So you're seeing those kind of things. That Fed funds rate, that's the rate they talk about in the press all the time with the Federal Reserve. It's down there. It's effectively, the range is 0 to 0.5. We graph it here at 0.25 just because it doesn't officially hit actually 0. That 10-year rate, like I told you this morning, it was like 0.9. These are monthly numbers, so I don't try to measure this on a daily or weekly basis. The rates are just far too volatile in terms of anywhere from 2 or 3 to 10 or 15 basis points. So it gets a little bit nervous there. I do expect that 10-year Treasury rate probably is going to come up between 1 and 1.25 during the course of 2021. Interest rates generally are going to do well, but it's not going to come back up to the 2, 3, 4% level, which is historically it's close to 4%. Is the long-term average for that 10-year Treasury. The rates are going to stay low. The mortgage rates are going to stay low. I don't think we're going to see anything more than maybe 3 and an eighth, something like that during the course of 2021, unless something radical happens. I've already told you that no economist really knows what's going on, and trying to project interest rates is the even difficult in good times and normal times. So take it with a grain of salt, but that's what it looks like it's going to do. Home builders, hey, that dark line is the home market index. That's more or less, if you want to interpret it, it's the optimism index for home builders across the country by the National Association of Home Builders. That 90 reading that it hit last month is the highest recording ever. I mean, the home builders are just going bonkers, and you can see the housing starts. The orange line is following suit, that it's coming back up, and the home builders, and I'm sure it's true in your area, that the home builders can sell a house. If they can build it, they can sell it. And incidentally, they just reported this morning that they're going to lower the tariff on lumber prices. So home costs here in the next few months probably should see a little bit of a help with the lumber prices coming back, the tariff on Canadian lumber. We get a lot of our lumber from Canada. New and existing home sales taking off, spiking. You'll see it's still not as good as it was before the Great Recession back over there in 2005, but relative to the last 15 years or more, it's been, or the last 12 years or more, it's been exceedingly high. And the new home sales following suit to going back up into this level of 1 million units plus or minus. It really should be closer to the 1,000,001 level. So it's still not up to where it could be or should be or potentially could be. And new and existing home sales, really should be above 6 million. That's the right-hand scale. So it's still got a ways to go. Texas has been leading the way. Our home sales in Texas leading the way, even over the U.S. We're still an active state. We still got people moving to the state, buying houses. Here's what this was our forecast. We thought 2020 sales would be up about 3.5%. And that's despite the dip that we took back in March and April. We still thought year to date we'd be, or for the whole year, be up by 3.5%. I got to tell you, year to date we're up over 5%. So our forecast there, that purple bar, is probably still pretty conservative as to where it is. Prices are going up rapidly. 4% might even be a little conservative. I know some of you probably seen the national numbers that several have come out here in the last couple of 3 weeks that indicate home prices across the board around the country are up anywhere from about 6 to 7.5%. We're going in like that as well. The median and averages are going up a little bit, but it's for a different reason. It's not actually the value of the homes or the prices. It's the fact that the distribution of sales has shifted. There's a greater share of the market, if you will, of homes above 500,000, and in other markets, higher price markets, above 750,000. That share of market of sales on the higher end is greater than it's been the last several years, which is causing the arithmetic of computing the average and the median to make those increases look a little more. Here's what's going on. Limited inventory. Yeah, I don't need to tell you. You can probably tell me. If you've got a house that's in a good location and priced right, you can sell it tomorrow. That's not a problem. New construction still limited. We're still not building enough. Ironically, the impact of the COVID-19 on the housing market has been actually to increase the demand of people wanting more space, either to leave the house they're in and go get another house, or leave apartments. Because if you're forced to work from home or a shutdown and you're in a 1-bedroom, 800 square foot apartment, it doesn't take long before claustrophobia sets in. And so there is this sort of shift in demand for more space. Well, to get more space and at an affordable price, you generally have to move out into the suburbs. You've got to move a little further out. Affordability then is becoming a real issue. And the irony is it's a full circle pattern, because if the houses get more expensive, if you can't afford to get the house, then you're forced back into renting. Well, it is increasing the market for rental single family homes. And of course, in your area, I know that you've got some home builders that are building subdivisions that are for rent rather than for sale. So we're seeing that coming in. The historically low interest rates are still the main draw. That's allowing things to happen. The ease of mortgage financing, actually the mortgage credit availability index that the mortgage bankers put out every month, is actually getting tighter. The lenders on conforming loans are getting a little tighter, requiring more down payment or higher FICO scores, more documentation about employment, because there's still nervousness about employment. We've got a lot of properties that are in forbearance, and that's going to give out somewhere down the line. I mean, technically the end of this month, but I know it's being extended, and really the extension is going to mean into next summer. And people are expecting a wave of foreclosures with distressed properties. That's not as likely. I don't think that's going to be as big a deal as it was back in 2008, 9, and 10 after the Great Recession. Yeah, there'll be some foreclosure. It's going to be more than quote unquote normal, but it isn't going to be quite as hard and quite as heavy as it was in that period of time. And now we've even got a lot of people that are kind of licking their chops, waiting for distressed properties to come on the market, come in and buy them and so forth. So we'll see how that all goes. Single family home building is up about nearly 10% statewide. And you can see, I've given you the comparison from the 80s. It took us 16 years to recover in single family building permits. We're 15 years out from our prior peak in 2005. But we're nowhere near hitting that peak. But 2020 is going to be a good, strong year. and it's going right into 2021. In fact, we're talking to builders that their backlog of contracts are such that even homes that they're starting now are going to start next month and so on. A lot of those homes are already under contract. They're already sold. So the big issue there is that a lot of our home builders are not going to have the capacity to be able to build a lot of spec homes that you're going to be able to sell as realtors. That's going to be a little interesting. Let me get to the Denton Wise County housing market and get through this and open up for some questions. Here's, according to the Realtors Association, the Greater Denton Wise County Association of Realtors, just through the MLS there. This is the pattern over the last 8-9 years. The 2020 sales are running, year to date, are running almost 11% greater than they were at the same time last year. So, you know, it's not, this is going to be a really good year. 2019 was slightly down. It effectively was flat if you look at the bars there, but it was slightly down. 2020 is going to be good. And I think this is going to carry right on into 2021, at least for the next 6 to 9 months. I don't see any real let up coming along the line. There is some concern that the low interest rates are inducing people to buy out into the future sometime. And there's some debate about how much of that future demand can you bring to today, and when does it give out? Well, quite honestly, that doesn't look like it's going to be the case, at least in the near term future. For the next year or two, I think we're good. I think you're still going to see good, heavy demand. Median price up over 5% on a year-to-date basis. Again, the distribution of sales having that. Here's the third quarter Denton County report. Most of you probably have seen this, or I know you have access to it if you're a member of if you're a realtor off of the Market Viewer of the Texas Realtors website. I know that because we supply it to them. You can see where the median price, and this is comparing the third quarter of 2020 to the third quarter of 2019. Median price up almost 6%. Closed sales up 21%. I mean, months inventory at 1.7 months down there in the bottom right-hand corner. Let me put it to you this way. In Aggie speak, you ain't got none. So that's a real problem. Active listings, that's one of the numbers we've been watching around the state, and you're not any different. In fact, your number is a little higher. You're down almost 42% from last year. Almost 50% fewer active listings. I mean, you all know as realtors and agents trying to sell houses, you got a real problem if you don't have houses to sell. And right now, sort of the name of the game is finding listings is as probably as difficult as finding buyers. Wise County, very similar. Median price up even almost 10%. And of course, Wise County is a little bit less expensive area to live. You can see that the closed sales are up 13%. Active listings only down about 14%. That's a lot easier in months inventory, though still at 3.2. That month's inventory number, a benchmark to compare it to, should probably be around 6 months. So at 3 months, it's still a very tight market, and that's the reason that median price is up a lot. You also, if you look at that price distribution graphic right there in the upper right-hand corner, what you'll see is that a lot of houses, almost 15%, almost 16%, are being sold now for over $400,000 in Wise County. Those are expensive homes in Wise County, and that's a larger percentage share of the market selling in those price categories than historically has been the case, which is one reason that median price number is up 10%, as opposed to maybe a truer measure. Here's the Denton County October sales summary. If you don't see this, again, this report, this page is available to you out there in the Market Viewer. And what the red circle up there at the very top, And yes, it includes townhomes and condos, although in Denton County, those are not major numbers in terms of what's going on. But what you'll see is October to October was up 30%. I mean, this October compared to last October, so much better. One of the things that's happened here in 2020 that is different, we haven't seen the normal seasonality pattern. We didn't see the normal peak in June, July, and then start tailing off August, September, October, November, December. At least September and October didn't show the same kind of tail off that the normal seasonal pattern. Again, we had to push forward from the demand from March and April when we had the collapse in the market. They got pushed into later markets, and then the low interest rates drawing buyers in from the future, so that the seasonality kind of went out the market. And there you can see the 11.6. That's the year-to-date number. I got to tell you, as an analyst, I really look at that number after about April, May. Once we get 4 or 5 months into the year, I look at that year-to-date number to really see what the market's doing, rather than the year-to-year change month to month. And out there in the blue box, you can see the number I pay more attention to is that price per square foot out there. That's the far right within the blue box. And you can see that on October basis up 7.7, but on a year-to-date basis up about 4.2%. To me, that's a better indicator of what home values are really doing, is moving at about 4%. And so on. And you can see the month's inventory out there. And for 1.4, 1.3 for single family, I've circled both of them. Again, in my Aggie speak, you just ain't got none. And then look at the new construction down at the bottom. You can see year to date, it's up 15% in terms of sales. Prices are not up that much. It's interesting because the home builders know that the sweet spot, the price points where they can sell the houses the easiest and their profit margins are maximized, is really in that 250 to 350 price bracket. Now that doesn't mean they're not building some more expensive, and maybe if they can, less expensive. But you see what's going on there. It's amazing on that. I was kind of amazed on the condo market, but it's such a small market, it doesn't make much difference. So here's what Denton County looks like. I think 2020 will be better than 2019 at the end of the day, and probably be up, like we said, we just noticed it's up almost 12%. So that 2019, if there was a bar out there for 2020, it's going to be up there, going up. Right, the rate of growth had been slowing down since 2016, but this year is going to be a remarkable year for the percent increases. Don't be surprised that it's not up 12, 13, 14%. Wise County, similar, up 13% year to date. Look at the October, it was up 74% relative to October a year ago. There again, you're not getting that seasonal drop off that you normally did. So October 2019, which had the normal seasonal drop off, and then this year we didn't, that difference is a 74% difference. Home prices going up a little faster, 6.3%. And you can see again, the existing home sales up 10% year to date, and new home sales up 23%. Months inventory, a little better than Denton County, but still significantly lower than what we would consider a balanced or normal market. And again, a similar kind of thing. Rate of growth is going to pick back up. 2018 had some drop off. But you're going to be up probably in the 20% bracket for sales increase of 2020 to 2019. Here's what it looks like if we graph it out in Denton County, and this is by the defined local market areas that the local association identified. You can see that the Denton, and incidentally, the little blue dots that you see in there, those are the actual sales. The green coloring, though, indicates that, and the dark green indicates that things are up 11% or more, both the sales on the left and the price per square foot over on the right. And with just a few exceptions, you can see that the market has been strong pretty much across the board. Similarly, for Wise County, you can see Decatur, and then down by Aurora and so forth. New Fairview, it just been flat in terms of sales. And again, the blue dots give you the indication of where the actual sales are taking place. And you can see that they're scattered also out into the county areas as well as in the cities or the towns specifically. Here's what I was talking about, the distribution of sales. I thought it was really interesting. In Denton County, over 80% of the sales are between 200,000 and 500,000. 18%, a fairly small percentage, are less than 250,000, and almost 0% less than 100,000. It just evidently it just doesn't happen there much. And you can see the long pole in the tent is the 300 to 400,000 price bracket. So that 250 to 400 is sort of the sweet spot. More than half, almost 60%, about 50% of the sales, half the sales in the county are between 250 and 4. But you can see it's still a fairly good percent are above 400,000 on up to the $1 million price tag. And so it's causing some of those meetings. And then look over to the right, you'll see months inventory extremely tight. And look at the sweet spot, the 250 to 400,000, 1 month's inventory, 1.4 months inventory. It's just, you know, and it ought to be out there with the red. It ought to be out there somewhere closer to that 6 months inventory to have quote unquote a balanced market. That's the traditional benchmark measure. And so we look at Denton County building permits. How are the builders doing? It looks like year to date, we're up about 7.5%. I think that by the year end, it'll look more like that 2018 bar. and it'll get back up to about that level, which is going to be significantly greater than 2019. 2019 had the drop off there. What's affecting the home building, of course, is available developed lots and labor, because the home builders are facing the same problem with labor availability and the virus and so forth, and mask and social distancing, and people getting sick and not being able to come out, and quarantines and all that. So the labor is affecting the general contractors, particularly the subcontractors. And so the availability of labor and developed lots affecting all of the production there. Wise County single family permits, a similar problem, similar issue. You can see that Wise County really went through a boom period back there in the early part of the decade of the century, in the early part of the 2000s. That it's going to take a while to come back to that level of development. And year to date is down about 6%. Probably going to be down a little bit for the year. Looks similar to 2019. 2021 is going to be very similar pattern to 2020 in Wise County. May even pick up a little bit more if this trend that we're beginning to see. And it's real difficult to get a handle on it. But if this trend of moving toward the suburbs for more space, which means more land area as well as more improvement space, more building space in the housing market, then we might see even more movement out to the Wise County area where the land prices are a little bit lower and easier to develop and put properties together for development for the builders. Here's the best two words that any economist can ever give you in a presentation is in conclusion. So here I'm gonna wrap this up and talk about, we're looking at a lot of different things going on in the real estate market. Don't have a good clear crystal ball. It's just as foggy as it can be. We do have this forbearance issue. We do know we're going to get foreclosures. We've had people laid off. The biggest reason for a foreclosure is you lose your job. And if you don't get your job back or get another job that pays as well, then you really do run the risk of foreclosure a lot more. Also, with more people being cooped up at home and to stay at home and don't get out and don't go to restaurants and so forth, I don't know, maybe we'll see an increase in the divorce rate, but that's a different issue. But we'll see an increase in foreclosures during the course of 2021. I don't think it'll be overwhelming. It won't be anything like we saw about 10 years ago. So we'll have to see how that goes. The moratorium on evictions in the apartment markets actually are holding up reasonably well, but people are doubling and tripling up. The recent report from Pew Research indicated that something close to about 48% of the people between 18 and 35 moved back in with their parents, which means we'll have an increase in the murder rate. But again, that's a different story. But those people are going to eventually get back out. Incidentally, that moving together, people doubling and tripling up, and the kids moving back in with the parents and so on, has decreased the number of households. And that's one reason, I know as realtors, you've watched this, the home ownership rate spiked here the last quarter, hitting 70% for Texas. And one of the reasons that it hit that rate was not only that, yeah, people were buying houses and moving into houses, but the number of households declined because of all of the doubling and tripling up and people moving back in with parents and so on. The low interest rates are going to continue to stimulate the housing demand. That's going to go on for at least another year, probably another year and a half before we see any kind of telltale sign that might start giving out a little bit. And I'm telling you something again that you probably can tell me more about it, but I can tell you that construction and brokerage and sales practices, lending practices, the new technology and new processes that have been forced on us, remote virtual tours, remote and online closings, the remote online notarizations that Texas allows, and the perfection of that with the title companies, that now you can list and sell a house and close the sale and literally never be in the physical presence with either the buyer or the seller or the lender or the title company. It'll all be done and can be done remote. And so all of the practices and all of the procedures that you've normally done, you've learned to do, we've had to learn to do things differently with as a result of a lot of this. The home construction is the prime recovery activity for the overall economy. The multiplier effect, you all know this as realtors and people in the real estate industry. New home construction multiplies itself into the economy. And right now, it is the driving force. It's the primary driving force in the economy. We have picked up in durable goods, auto sales, and some other things are up too, but the home market is doing. The commercial real estate market, you'll notice I haven't said that much about it. There's going to be a resetting of the commercial market. The hotels and retail properties in particular are going to get reset, and values are going to get reset, particularly downward. They're in a lot of trouble. The regional malls almost across the board are in trouble. Almost all the hotels and motels are in trouble with the vacancies, occupancy rates. They just can't operate at 40 and 50% occupancy rates. If they're not up at around 75%, they're in big trouble with the ADRs that they get. So the hotels are going to get revalued and dropped in value. The retail properties, even the office sector, we're going to start seeing it because if more and more of us are going to be working remotely and not necessarily need office space or have to have as much office space, and the office space that we need is going to need to be refigured and configured with partitions and so forth for the spacing and social distancing. But it's going to take a little while for that to work through, particularly in the office sector. It'll happen faster in hotel and apartments and retail. Apartments so far have held out pretty well. And as home prices start rising even more, it's going to force some households to have to go into rental, either single family rental or into multifamily rental. So the CRE was sort of a wait and see. We're looking for it. We're all expecting it. Right now, if you're an appraiser, Lord bless you, because it's going to be really difficult until we get sales volumes and people and investors and developers and buyers and sellers of these commercial properties kind of figure out what they're going to pay. Cap rates are more than likely going to go up, which is again going to be a factor in lowering values, along with lower rents or fewer lower rent income, either from lower rents or higher vacancy factors, lowering the NOI to lower those values. But so far, it's been really difficult to discern all of that and empirically pull it out of the marketplace. So we haven't seen all of these value impacts yet, but they're coming, and I do appreciate your attention. And Rebecca, I'm open for some questions if we have time for it.
We do. We're at the technical end of our formal presentation, 12:30. Thank you all for joining us and learning together. And absolutely, let's open it up for questions for Dr. Gaines here. Should we have any? I guess let's just kind of unmute yourself and jump out there and let's tackle Dr. Gaines.
Dalton. Go ahead, Dalton, unmute.
Dr. Gaines, you, in one of your past presentations, you talked about the future of Denton County and what was going to happen in terms of total number of people in the area. I know the pandemic has changed some of that, as well as some other things. Do you have, before we were talking about by 2050 having at least 3 million people in Denton County. I remember that well. It was a shocker, but I agreed with you at the time. I don't know how to view this today. Do you?
Dalton, that's a great question, and I did anticipate it a little bit, because when I was putting this presentation together, I went back into my old presentations and I found the chart that I used and I put up in the slides with the projection of Denton County population, and in fact that got adjusted here in 2018. The state demographer's office had adjusted it downward just a little bit. I'll tell you the reason I chose not to include it was because of all the uncertainty going on. And of course, we've got a census that's going to come out here within about the next 12 months. So instead of confusing everybody, including myself, I chose not to say it. I think you heard me say in the presentation that people are still moving to Denton County. The population's still increasing. I'm just not sure I'm ready to say. I don't think anybody's ready to say right now what that's going to look like, and not just the next year or two. The next year or two going to take care of themselves anyway. But over the next 20, 30, 40 years, actually, I would love to make a 40-year projection, because I can tell you right now, I ain't going to be here to have to defend it. So yeah, it could be 3 million. I mean, all of you can see that the whole metroplex is growing and it's expanding outward. And Denton County and Denton and Collin counties particularly are in that pattern of growth. And Wise County is going to start picking it up too. And I think that was what I was saying, that this pandemic, one of the outcomes maybe of the COVID, of people looking for space and moving a little further out. And if we go from 8 or 9% of the labor force working from home to maybe 25 to 30% of the labor force working from home, then you could live in, and you don't have to put up with all that traffic in Dallas County or in Denton County, and go out and live in Wise County. So I don't think there's any doubt that you're going to see the population growth. To put a number on it right now, I'm real hesitant to do that. So I left that. I literally yesterday, I was working on this presentation. I had that graph in the presentation. I took it out because I didn't know how the hell to defend it.
Well, I fully understand. That's why I asked the question, because I also didn't know. I know that you had about 4 million in Collin County, 3 million in Denton County. By the time you add Dallas and Fort Worth, we have a metroplex as it goes of 20 million people by.
Yeah, I think the last projection I saw for the whole metroplex was to go from the current little over 7.5 million to by 2050 to somewhere north of 16 or 17 million.
Yeah.
Now, but it's not a straight line to get there. So
sure,
but the population growth, Texas is still a magnet for a lot of businesses and a lot of people because of our social structure, our business structure, our weather, being in the central time zone, and the best Tex-Mex food in the world.
Well, thank you for
Incidentally, one of the anecdotes I heard just within the last month if you're not aware of it, California this year raised the top marginal tax rate on people with incomes more than 400,000 to nearly 20%. That's the state rate.
Yeah.
What I didn't know was that Arizona followed suit and raised the top marginal rate for, again, high income earners from about 3.5% to nearly 8%. So now a lot of those Californians that had been moving to Arizona are now skipping over Arizona.
Mhm.
And of course, there's nothing in New Mexico anyway. So they're coming to Texas.
Dr. Gaines, if I might, unless somebody else wants to jump in here, one of the confusions that I have is what really is going to happen in the next 5 to 10 years in terms of real estate prices. We've got so many different things happening with forbearances and no evictions, and I know that the commercial side, I believe that's going to take some adjustment for a while without a doubt, but $15 wages as a minimum wage can make a huge difference in a lot of small businesses that don't pay that, and the prices that rise. There's so many things on the horizon. I don't know how to put all of that into pieces. What are your thoughts?
There's no doubt, but what over time, the price of housing, which I assume is what you're asking about.
Yes.
The price of housing is going to go up. I mean, it's just a matter of at what rate over what period of time. As incomes increase, as more higher paid jobs are created, either through a minimum wage or just simply from the fact that companies are forced to pay their employees more money. We've got demographics working for us. The millennial generation, and that's your market right now. Everybody, really it's the 20 and 30 somethings, but think of it as being basically the 27 to 40-year-olds right now. They're entering the home buying market. That's the best educated demographic group in terms of level of more college graduates and so forth. The pace of sales to single women is one of the things that came out in the recent NAR report on buyer-seller profiles, which was kind of interesting. So there's no doubt, and as long as we still have the strong demand and the relatively short supply, I mean, that's the reason I was harping on those months inventory numbers when I was going through it there for Denton and Wise County. I mean, when you're down 1.5, 2 months, 2.5 months, 3 months of inventory, and you still have strong demand, that's a lot of pressure, upward pressure on prices. And we're right now, though, if you think about it, I mean, Dallas-Fort Worth area, again, I'm doing it at the metropolitan level here because you're a part of it. DFW is one of the lowest cost major MSAs in the United States.
Yep.
It's number 4 in size. It's the number 4 MSA. You got New York, you got LA, you got Chicago, you got Dallas-Fort Worth. So it's number 4, but it's night and day comparison for housing costs. And ultimately the demand is going to pick up that pressure on the prices. The good news is we're still able to build homes in that 250 to 350 price range, somewhere in the MSA. You can't, it's hard to do it in Dallas County, but you can do it in Denton County, and you can do it in Wise County.
My concern was hyperinflation with all the government debt, both federal, state, and local, et cetera, that hyperinflation could actually get in there, and that in itself is a huge problem. So
yeah, and I that's above my pay grade to try to figure that one out. Right. But the general concept is there, and as long as we're such an attractive area for people to live and work and jobs to be created and so on, it's going to continue to have that upward pressure on the prices. Now, I don't think we'll ever be a New York or a San Francisco or and have prices approaching they've got residential prices that are over $1,000 a square foot in those markets, if you're not aware of it. I don't think we're in danger of that, at least anytime soon. But we're going to see it continuously. And for those of you who've been, in the business for a while, just think of what it was if you can think that far back 20 years ago, what the average or median price was of a home and what it is today, and then try to project that to 20 years from now. And I'm thinking 20 years rather than 1 or 2 or 3 years, but a little bit longer period of time. Sorry, I don't mean to ramble on about it.
Thank you.
Great Q&A. Any other questions for Dr. Gaines? Just jump in there, folks.
Well, thank you very much. It's great to see. I recognize several faces and names, and when I don't see the face, at least I see the name on there.
On that point, Dr. Gaines, if I may take the liberty, would you share your information, I guess your update at your update? That's all I'm going to say. Would you like to share that with us?
Oh, well, it's no secret, but I have filed to retire here at the end of the month.
So this is one of Dr. Gaines' very last presentation, and I wanted to acknowledge, with us, I should say. So I wanted to acknowledge all the many years of help and support and just unsurpassed information that you have presented to us in many groups and settings. And I'm personally so very thankful for your friendship and, again, many years of service. And I wanted to make sure everybody here knew that great honors are due for Dr. Gaines. And
thank you, Rebecca. I'm not going to go drifting off into the sunset yet. So I'll probably still be around for another year or two doing this sort of on an ad hoc basis, but it won't be quite as organized. So you may wind up having to see me again sometime.
yeah, I know where he lives. We got him.
Yes, Barbara.
I said, have you got a replacement for yourself? Because I'm sure that Gary Mailer is not happy about this.
No, he's not.
You will be missed.
Thank you, Barbara. Appreciate it.